Hello, hello, everyone, and welcome. As you're entering, please go ahead and put your name in the chat for documentation purposes, please. We're going to give a few moments to make sure that we have allowed as many as participants as we can into the chat or into the room, and then we will go ahead and get started here shortly. As a reminder, just drop your name in the chat if you're here. And we will be getting started shortly. Thank you. Awesome to see so many people joining the room. Thank you for dropping your information in the chat. As I said, we will be getting started shortly. Want to preface that we are going to be declining any note takers, and I will explain that as we get to our disclaimer. So just in case you were wondering why your note taker is not going through, that is the reason. So thank you. All right. Margaret, are there, you could just simply give me a thumbs up. Uh, are we good to go? Do we need to wait for a few more people? How is the waiting room looking?
We are all set. We don't have anybody in the waiting room right now, but if anybody else joins in, I'll make sure to admit them as soon as they come up.
Awesome. Sounds good. Thank you so much. So welcome everyone. My name is Marlene Toby, Senior Associate with Civitas Strategies. I have my colleague here, Margaret, on the line for support. She will be dropping information in the chat for you as we go. But welcome to tonight's presentation, Tax Strategies for Childcare Businesses. Now, first, before we begin, please keep in mind that this presentation is for educational purposes and not to be taken as legal or tax advice. And though the information contained here has been prepared by Civitas Strategies and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information and recording of this content, including the use of AI, are expressly prohibited. Only non-commercial uses of this work are permitted. All right, so thank you so much for joining us. As I said, Margaret has dropped some information for you in the chats. We will be doing a Q&A session at the end of the presentation. So if you would, please hold your questions. Feel free to drop them in the chat, but we will hold your questions until the end of the presentation, at which time we will address them during the Q&A. All right. So welcome again. Today's session will be covering several important tax topics to help you run your childcare business smoothly year round, not just during tax season. Now, first, we will discuss why you should care about your taxes, not just on April 15th. Next, we will explain what the Schedule C is, how you can use it, so that you can report your childcare business income and the expenses. We will also go over steps that you should take now to get organized and prepare for tax filing season next year. And then finally, we will share some tips that so that you can proactively mitigate your tax burden through deductions, contributions, retirement plans, and more. Now, our goal today is to provide you with tax knowledge to optimize your filing and minimize those headaches when tax season rolls around again. So, knowing how to effectively address taxes can help you with several things. Number one, it can help with profit retention. Now, while it is the responsibility of every business to pay their fair share of taxes, proper tax preparation can be a vehicle for recapturing your hard earned profits and basically keeping more money in your pocket. So, understanding those allowable expense results will help you to legitimately pay less taxes and retain your profits. Well, the second reason is for risk mitigation. Education is key when it comes to understanding allowable expenses and properly preparing your taxes. The more that you are aware of the tax rules as they apply to your childcare business, the less likely you are to trigger a costly IRS audit. Audits are very time consuming, they can cause distress, and at the end of the process, they may prove to be very costly with you owing money that you may not be prepared to pay. The third reason is understanding your business health. Reviewing your taxes is a fantastic way to evaluate the health of your business. Now, having an accurate account of profit really allows you to understand the financial position that your business is in, and it can help you to plan for changes going into the future. And the fourth reason is to build business confidence. Now, as I mentioned, knowledge is key. So, having confidence and knowing that you have properly claimed your deductions and that you have met your tax obligation, it basically removes the factor of the unknown. So, understanding taxes gives you the ability to continue to operate with that mindset that you're following the rules that are set by the IRS and that you're unlikely to have an unforeseen any unforeseen debt and potential future issues. Excuse me a moment while I take a drink of my water. All right. Hmm. So through our years of hands-on experience supporting childcare providers with tax-related challenges, we've basically recognized the need to identify some key areas where business could improve their tax filing practices. So, to ensure that our guidance would be truly excuse me, I have a little frog in my throat today. We conducted a comprehensive analysis of childcare business tax returns. Now, this research helped us pinpoint specific opportunities where providers could enhance their tax preparation strategies and maximize their benefits. So, our research on past taxes illuminated several findings that we have tracked while working with childcare providers every day. The first is that a striking 83% of home based childcare providers did not claim the business use of home on the Schedule C, line 30. Now, as a home based provider, uh, you can deduct expenses shared between your business and personal use of your home. That's a significant missed opportunity for taxes. And these deductions can include portions of your utilities, your mortgage interest, property taxes, and maintenance costs that are related to operating your business. So We want you to make sure that you are claiming that deduction. Another finding was we discovered cases where providers reported no expenses at all on their tax returns. Now, this is concerning since every single childcare operation inherently uh, incurs debt and expenses. Schedule C offers numerous expense categories, and understanding these can help you reduce that tax liability while still preserving more of your profit for your business. From educational supplies to toys and cleaning materials, professional development costs, these expenses are essential to document and claim. So, no provider should ever not have expenses. The next finding was that some providers claimed inappropriate business expenses, significantly increasing their audit risks. Now, remember that deductible expenses must be both what they call ordinary and necessary for your childcare business. Now, the IRS has a specific expectation for what constitutes valid expenses in the childcare industry, and deviations from these norms can trigger additional scrutiny on your taxes. So it's crucial to maintain clear documentation and ensure that each expense directly relates to your child care operations. Another finding was that common deductions were frequently miscategorized or incorrectly calculated, potentially triggering another basically automatic audit or a flag. Now, here's an example. Many providers mistakenly list the children's meals under the Schedule C business meals deduction line, which is actually intended for travel related to business meals. Now, even when the expense itself is legitimate, improper categorization can lead to unwanted IRS attention. So, understanding the correct classification of expenses is just as important as identifying your deductible items. Now, these findings underscore the importance of understanding proper tax preparation that is specific to your business. So, accurate documentation and proper categorization of your expenses can help maximize you to have those legitimate deductions and avoid some of those unnecessary risk of audit. All right. So while there are various tax forms that you'll encounter as a business owner, we do want to focus on the Schedule C. This is a crucial document for reporting business income and expenses. So even if you work with a tax professional, understanding these basics will help you make more informed decisions for your business. So the Schedule C is used to report income for sole proprietorships as part of your 1040, your personal 1040 tax returns. Now, single member LLCs that haven't elected to be taxed as a corporation will also use this form. However, if your LLC has chosen to file as an S or C corporation, your business income won't be reported on your personal return. Now, it's important to note that if if you operate multiple unrelated businesses, you'll need a separate Schedule C form for each business. Now, here's an example. If you say are running both a craft business on Etsy and driving for a rideshare service like Lyft or Uber, that would require two distinct Schedule C forms because those businesses are not directly related. Now, the basic structure of the Schedule C follows a straightforward logic. First, you're going to report your total revenue. Now, that is all the income that you've received from your business operations. The next thing you will do is list all your business expenses. Those are the costs that are necessary to run your business. And then finally, you're going to calculate the difference between your revenue and expenses. And a positive number will indicate profit, while a negative number will show a potential loss. Now, this calculation provides a clear picture of your business's financial performance for that tax year. Now, understanding how to properly categorize and report your income and expenses on the Schedule C is important for the accurate filing and, of course, maintaining good business records. Now, let's take a closer look at the Schedule C to view the different sections for reporting the data on your business. Now, if you use tax software, it will basically enter these numbers in for you as you answer certain questions, but it can still be helpful for you to know your way around this important document. Knowledge is key, of course, when it comes to your business taxes. So even if someone else is preparing your taxes, you will want to understand the Schedule C. So let's take a look at the pink section, part one. This is where your sales are totaled and your cost of goods sold is reported so that you can see your gross profit. Now, just a quick mention about the cost of goods on your taxes. It's also referred to as COGS. Cost of goods sold refers to the sale of products rather than services. Now, this is very rare that childcare businesses will have an entity or an entry, under cost of goods sold section. In part two, which is the green section, this is where your business expenses are reported. Now, this is an area on the Schedule C that you'll want to be very acquainted with. There are over a dozen categories listed to help you stay organized, such as advertising, car and truck expenses, legal and professional services, rent, the list goes on and on. So those allowable expenses are what reduce your profit, thereby reducing your tax liability. So accurately including all your allowable expenses is critical when you're filing this Schedule C. Now, the last section in the gray is where your net profit is calculated on line 31. And you do this by subtracting your total expenses in part two from your total revenue in part one. And then your net profit is considered your income from self-employment. Now let's switch gears a little bit and discuss how you can proactively prepare for tax season to avoid headaches down the road, as proper preparation is, of course, key to helping you tackle tax time like a pro. Here is a valuable resource to highlight for tax preparation. This workbook from Playground aims to help home-based childcare providers optimize their tax preparation process and, of course, maximize those deductions. Need a little drink. Now, it covers some key topics like record keeping best practices that you can implement now, such as tackling income, expenses, mileage, things to that nature, and of course, the business use of home. Understanding the Schedule C and where you can capture income and different types of business expenses. It talks about how the business use of home deduction actually works. It includes the calculating and documenting the time space percentage, which we will go over this evening. Maximizing write-offs with eligible deductions for supplies, meals, utilities, repairs, insurance, and much more. Tracking and claiming automobile mileage for your business travel. Depreciating assets like equipment and furnishings over time. Choosing the right business structure, such as an LLC versus a sole proprietorship, and proactive tax planning steps that you can take this year to maximize next year's returns. Now, the workbook does include checklists, guides, and visual examples that walk you through every step to support you in preparing for the tax season by providing some actionable steps that you can take and implement now to make tax time a little bit easier. If you look over at the chat, we have dropped a link there for you. So we highly encourage everyone to take a look and download these valuable resources in there. Now, when it does come to understanding your taxes, you'll find that it's all about what you made and what you spent. Now, the first section of your taxes is about revenue, and that is how much money you made. Now, getting this information may be easy if you have an accounting system. But if not, no worries. You can use the attached revenue worksheet to calculate it. And we will show you an example of that here in just a second. But first, you're going to start by gathering your records. You are likely to have three types of records for revenue. Now, the first are 1099 forms. Now, many home based childcare businesses will receive a 1099 for evidence that another business paid you for services. And these typically include subsidy payments and participation in CACFP, which is the Child and Adult Care Food Program. Now, you may have heard that if you receive 600 or more in payments through payment apps like Venmo or Zelle or things to that nature, that you would receive a 1099K for your for the 2023 tax year. However, in November, the IRS decided to not enact that rule. So for 2023, you would have only received a 1099 from payment apps if you received payments exceeding $20,000 and had more than 200 transactions. Now, in 2024, that threshold changed to payments exceeding $5,000. The threshold for 2025 would be for payments exceeding $2,500 and then $600 for 2026. Now, we do recommend that in the coming years, you listen for an announcement to see if the thresholds have changed, but we have no way of really knowing if that will be the case. So we do recommend that you keep your ear out for that. Now, having said that, you do need to report all of your income that you've received via payment apps as income, even if you don't receive the 1099 for it. You'll just add the amount that you received throughout the year on your revenue. Now, the second is going to be the source is going to be bank records. These are showing additional funds that you may have received from other sources. And then, of course, you may get information from your own documents, such as year-end or weekly receipts that show that the parents paid for care. Now, in the chat, you will see a link that was dropped for this revenue worksheet, which is something that you will fill out and include each 1099 and revenue for each child that you serve. Now, also, you're going to want to list other income, such as grants that may not already be accounted for in a 1099. Now, if you receive reimbursement for food costs through the food program, you can report all of your reimbursements under the income section. That's part one of your Schedule C, using those 1099s that you received. And then you can simply deduct your food expenses in full in the expense section. So once you have your business income, you'll need to collect your expenses. Now, this will be, of course, what you spent money on for your business in the previous year. You want to make sure that you have records of your cost, ideally receipts showing payments for those expenses, but you can also, in most cases, use canceled checks, invoices, or credit card and bank records. Now, it's very important that any proof of an expense show the following: one, that you paid the expense; two, the amount that you paid; three, the date that you paid it; and finally, a description of the item that was purchased or the service received. Now, the mileage log included as a resource in this guide, and we of also or will be sharing via the chat, is a simple log that you can use to fill in your vehicle use information. Now, to collect your expenses, you will want to start by collecting all of your receipts. Next, you're going to go month by month in your records for the previous year to review your credit card bills, check those app-based payment systems such as Venmo, Zelle, PayPal, Square Cash. And then you're going to look at your bank statements and checks. Now, with your accumulated expenses, you can now fill out the digital expense worksheet, including the guide on one of the within the workbook. Now, the worksheet uses the expense categories for Schedule C that are most relevant to your home-based childcare businesses, but they can also be used for any corporate or partnership tax returns as well. Now, the full amount of home expenses that are directly related to your business can be included in your expenses in this table. Now, the IRS defines a direct expense as one that is incurred exclusively for the business and provides no personal benefit. Now, some examples of direct expenses in your home are if you were fixing a bathroom used only by the childcare children, getting a new children's rug for the play area, or maybe even playground equipment. Now, indirect costs associated with your home, such as your homeowner's insurance or your electric bill, those will be covered in the following section, which does cover your business use of home. Now, you should hold on to all proof of payments throughout the tax season and at least 4 years thereafter. Now, it's a great idea to have both electronic and paper copies, even if you're simply taking a picture of your copies on your phone. We do highly recommend that you have a backup copy to the other. Now we're going to go over a few categories that are often considered to be tricky topics, and those are vehicle, food, home, and grant funding. We're going to start with transportation. Now, as with all deductions, there are some very specific rules and guidelines that you will have to follow. Here are all the elements that you need to make sure that your transportation is deductible. First, it must be in the regular course of doing business and related directly to your childcare, like if you are transporting the children. And it also must be business related, such as if you're going to the grocery store to pick up milk or supplies for the children. So you always need to keep your personal and business travel separate. Now, when it comes to business trips, the primary rule is that the trip can be both for personal and business purposes, but it is only deductible if the primary purpose of the trip was for business. Now, I'll give you some specific examples. Let's say you were going to Costco, you wanted to purchase a long list of supplies for your childcare center, and you happened to pick up a personal item like a jar of pickles on the way. Now, the trip would still be deductible since supplying your business was the main reason for going in the first place. However, if you went to the grocery store for your own groceries and you just so happened to pick up an item or two that you needed for the child care center, that trip would not be deductible since your personal errands were the primary purpose of the trip. Okay. So the key is really looking at why the trip was necessary in the first place. If the main purpose was for business, it can be deductible. It could be a deductible trip, even if you happen to pick up a personal item or two along the way. But if the primary purpose, got to get that word out, if the primary purpose was personal, with just an incidental business purchase here or there, then it would not qualify as a business expense. And again, I see you have questions. Keep dropping those in the chat. We will address all of those when we get towards the end. Now, if you happen to use a vehicle to conduct your business, then you may be wondering how you can deduct that transportation cost. So there are two ways that you can do this for your vehicle expenses, and those are the standard mileage rate and the actual expense method, which we'll go over both of those and the pros and cons. So, the actual expense method captures all costs associated with your vehicle, but it requires extensive documentation, including keeping every receipt and logging mileage for both your personal and business use. Now, the pros of this method is it may result in, of course, a higher deduction, especially if you're using your vehicle extensively for work. However, the cons are that it may take a more significant amount of time to collect and retain the receipts and mileage logs. Now, while the actual expense method can provide a larger write off, it also demands careful record keeping so that you can track both your business and personal use, as well as proof of payment for all vehicle costs. Now, alternatively, to track all actual expenses, you can use the IRS standard mileage rate, which simplifies deduction tracking, but it still requires some detailed logs in your business logs of the business miles that you've driven. Now, the pros of standard mileage are the ease of calculation, and there are fewer records to collect as you only need to track your business miles, not necessarily your personal miles. However, the cons are that the deduction is limited to a fixed rate that is set by the IRS, and your records may get greater scrutiny. Now, regardless of whether you are using the actual expense or the standard mileage, you will still need a log noting the date, the distance traveled, the location, and the purpose of each trip, specifying business versus personal. Now, um, while standard mileage rates reduces your documentation burden, you still must carefully track your mileage in a log along with the trip details so that you can justify that deduction. And we do encourage you to compare the effort needed for each method when you're deciding which one will work best for your tax purposes. All right, moving on to food. The basics for deductions for food and meals are that food is fully deductible with two exceptions. The big question is, how do you do it? Children in your care are fully deductible, and you can report the cost in multiple ways. For staff, only 50% is deductible. And for your own children, those costs are not deductible. Now, there are, again, two methods that you can use to deduct your food costs. Excuse me. And that is the actual expense or the standard meal rate. Now you can deduct as a business expense 100% of the actual cost of food consumed by your daycare children, and generally 50% of the cost of food that is consumed by your employees. However, you can deduct 100% of the cost for food consumed by your employees if the value can be excluded from their wages as a de minimis fringe benefit. That basically just means benefits that you can give employees that are lower in value and excludable from their taxable income. Now, to simplify record keeping requirements, there is an optional standard meal and snack rate that family childcare providers may use in computing the deductible cost of food provided to the children in care, and that's in lieu of the actual cost. Now, how is this done? Well, you do this by keeping track of your meal types, the numbers, and then you simply multiply by the set number that the IRS has set. Now, pros and cons. Pros are that, of course, there's easier record keeping, and you can still deduct non-reimbursed meals and snacks. The cons are that you still need to keep the names of each eligible child, dates and hours of attendance, and the number and types of meals served, which is what most people do if they're on the food program anyway. Now, the food program reimbursement rates can be used by home-based childcare providers to simplify the calculation of food costs, regardless if you are participating in the food program or not. So everybody can use this. We will drop a link in the chat so that you can see those rates, but the rates are based on tier 1 rates under the food program. The provider may use the standard meal and snack rate for a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day. Now, of course, these are the meals that you serve the children. Now, this varies from what the food program reimbursement allowances are, which are typically 2 meals and a snack or 2 snacks and a meal. Now, again, we will link that in the chat for you so that you can take a look at those reimbursement rates through the food program. All right, on to the home. To figure out how much of your expenses are considered business expenses and what percentage of those expenses can be deducted on your federal income tax, family childcare providers will use the time space calculation. Now, in time space, you classify your space as either regular use or exclusive use. So let's look at the definition for both really quick. So regular use are those areas that you use all day, such as a play area, or part of the day, like your napping areas. But you may have other uses during those non-business hours. Let's say the bedroom is used for a napping area, and that's also where you sleep or your children in your home may sleep. Now, exclusive use areas are used only for your childcare program and nothing else. Now let's look at a few examples to really expound on exclusive and regular. Exclusive use would be having a separate basement entrance that's only used by your families for the childcare business, or a storage room that only contains the toys and supplies for your business. Now, on the other hand, regular use would be using your bedroom daily for nap time for the children, or maybe even using your living room for weekly STEM activities. Now, exclusive use spaces can be fully deducted based on the percentage of the total home square footage, since it is 100% for business use. Regular use is deductible based on the percentage of time that it's used by the business rather than your personal needs. Now, properly documenting both types of usage is going to be key in justifying your home office deduction. We have dropped a link in the chat for the time space calculation tool. And as I said, we will go over that in just a sec. Now, home cost can be fully or partially deductible depending on the nature of the expense. Costs for exclusive use spaces are direct business costs, and they are likely to be fully deductible. Again, these are things like replacing tile in the basement that you only use for the childcare, installing a child-sized toilet, um, or having liability insurance. Now, of course, these are fully deductible because these are things that you only have for your business and no other reason. Now, again, expenses for regular use spaces or common improvement areas are only partially deductible based on the business use percentage. So examples here would be replacing all of your windows or repaving your driveway, or having homeowners insurance, renters, since those impact the entire property. Now, in regularly used areas, you need to use the time space calculation to determine how much can be deducted. So we have already referenced time space. So uh, we'll talk more about that, like I said, just a second. But the key is identifying whether the cost directly supports the business, benefits shared spaces, or is a general home improvement. And that's how you're going to determine if it is fully, partially, or non-deductible. All right. So remember that in time space, you classify your spaces as either regular use or exclusive use. Now, the time portion of time space calculation weighs how much time regular areas are used for business. Like we said, exclusively used spaces are weighted at that 100% because there are no other uses for those spaces. Whereas your regular use spaces are weighed at the portion of time that your home is used for business purposes. Now, you can determine if the time space calculation, you can determine your time space calculation by using these 6 easy steps. First is to determine the square footage of your regular use space in your home. Then step 2 would be to divide the number by your home's total square footage. Step 3 would be to determine the amount of time that your home is used for childcare. Step 4 is to divide by the hours which we have provided for you, total hours in a year, which are 8,760. And then step 5, you're going to multiply the time and the space percentages. And then in step 6, you simply divide the exclusive use space by the total square footage of your home and then add it to the results that you received in step 5. Using these simple steps, you can easily determine how many of your expenses can be reimbursed or deducted from your federal income tax. Now, here's an example that you can attempt to calculate on your own or with me. Using the steps from the previous slide, we're going to see if we can determine what this provider's time space percentage would be. Now, I'll give us a few moments to kind of review the information on this slide. And then on the next slide, we will go over it as a group. Now, for this particular business, it has a home that is 1,500 square feet. 500 square feet are exclusively used for your childcare or her childcare. Another 700 square feet is for regular use. And she is open 10 hours a day and spends 1 hour before and an hour after for prep and cleanup. And of course, she is closed 2 weeks out of the year for vacation. We know that there are 52 weeks in a year. So we will get to that math in a minute so that we know what to use in our calculation. Now, Let's walk through this example together step by step. Step one was to determine the square footage of the regular use space. Now, this is an easy one because in this case, we already know that the total home is 1,500 square feet and 700 square feet are used regularly. Now, if you need to make these calculations yourself, the formula is simply length times width equals square footage. Now, if you happen to have oddly shaped spaces in your home, like a nook or a closet or an odd corner, um, the calculation is pretty much the same. You're just going to simply break your room into smaller rectangular blocks and then use the square footage calculation, length times width equals square footage, to get each of those blocks. And then you're simply going to add those totals together. And that's how you get the square footage of an oddly shaped room. Then we move on to step two. Step two is to divide the square footage of the regular used childcare space by the square footage of the home to determine the percentage. So we already know that 700 was regular use. We're going to divide it by the 1,500 total square footage of the home, which will give us a decimal, which we can then convert into 46.6% by simply moving the decimal over two spaces to the right. Now, keep in mind that square footage for outdoor areas cannot, I'm going to repeat that, square footage for outdoor areas cannot be included in the time space calculation unless the external space is physically attached to the home and regularly used for childcare. Now, we're referencing things like a deck or an enclosed porch. Those can be included in your calculation. But if we're talking about an external structure that is not attached to the home, then no. Then we move on to step three. That is to determine the amount of time that the home was used for childcare during the year. So to do this, we're just going to calculate how many hours the children, how many hours the childcare space is open per week, including the time that was spent prepping and cleaning when the children were not present. And then we'll simply multiply that number by the number of weeks that the provider was open for service and add to any work hours that were performed while the provider was closed. So with this being said, we know that she was open 10 hours per day. She spent an hour of prep and an hour cleaning up. So if we add all that together, it gives us 12 total hours used. We're going to take our 12 hours per day. We're going to multiply that by 5 days a week. Remember, she took 2 weeks of vacation, so she's only open 50 weeks a year. And all of that together gives us 3,000 hours. Okay, hopefully everybody's following along. Step four is then to divide the hours that the home was used for care by that number we gave you, which was 8,760 total hours for the year. So we take our 3,000 that we just calculated, divide it by 8,760. It gives us a decimal, which we then can convert to a percentage of 34.2. Moving on to step five, we're going to multiply the time and the space percentages. So we do this by taking the square footage percentage that we had, which was the 46.6, and the hours per year percentage, which we just calculated at 34.2, and we're simply going to multiply those together. Now, to do that, you're going to need to convert those back to decimals, and you're going to get another decimal of 0.159, which is basically 15.9%. In step six, the final step, we're going to divide the exclusive use spaces by the total square footage of the home and add it to the results that you just got in step five. So we know that her she had 500 square feet used exclusively for the childcare. So the total home is 1,500 square feet. We're going to divide the 500 by the 1,500. And then we're going to take that result and add it to the decimal that we calculated in step 5, which was the 15.9%. And that gives us a total of 49.2% when you convert it to a decimal, or convert it from a decimal. So this provider's allowable time space percentage deduction would be 49.2 of allowable home expenses. Now, if you would like to practice more on time space, there is an example and a worksheet that's available on page 16 in the workbook. Keep your questions coming. I see them in the chat. We'll get to those in just a moment. Now, the general rule of thumb is that any grant money received must be reported as income. However, you can deduct any valid business expense associated with that grant money in the same tax year. Now, the timing of when the grant income is received versus when the expenses are incurred can impact your tax situation. So let's take a look at 3 different scenarios to see how that could change. Now, here is the basic one, very straightforward. Your business receives a $10,000 stabilization grant, which you report as revenue and spend it on expenses in the same year. Now, in this case, nothing changes on your taxes. You received 10,000, you spent 10,000, there's zeroable taxable income. Now, let's say that the business got the same $10,000 grant, but only had $5,000 in expenses. Now, in this case, you're going to have to spend or pay taxes on the $5,000 difference. Because you received 10, you only spent 5, that leaves 5,000 that you will need to pay taxes on. And finally, let's assume that the business received the $10,000, but as with many grants, you were able to attribute that spending that happened in a previous year. So in this case, you would have to pay taxes on all $10,000 because it was expensed in a different year. And I think I have that a little bit backwards, but we'll work on that. Now, the tax year has ended, but does this mean that you have no options for mitigating your taxes last year? Nope, it doesn't. If you're still looking for a way to mitigate your taxes from 2024, you still have an option by contributing to retirement plans. Now, if you don't already have a retirement plan for your business, setting up one could provide tax advantages, and contributing or your contributions rather that are made to your retirement plan on behalf of the business owner and the employees are typically tax deductible. Now, as a small business owner, you can open a SEP IRA for both you and your employees from January through April 15th. Make contributions and reduce your previous year's taxes. So you will want to discuss this option if you elect to do this with a financial institution or a tax professional for more information on setting up those retirement accounts and how that works. But you do have an option there. Now, while you may not have options other than retirement plans to mitigate your taxes after December 31st, if you find yourself with higher taxable profits than you expected, it is the perfect time to use that money wisely. So consider the following actions to make the best use of your tax funds. The first is to pay down your debt. Now, if your business has debt, this could be a great opportunity for you to pay them down. this could save you money in the long run because it's going to reduce the total amount of interest that you pay. A second option is creating a reserve fund. Having financial cushion, that can be a very beneficial thing for your business because if you have higher profits and steady expenses, you may want to consider setting aside some of those funds from your profit into a reserve fund to cover future expenses or unexpected costs. Now, oftentimes we get a question about how much should we invest. If you're just getting started, we would say aim for 1 to 3 months of operational expenses. But the goal should be to have a minimum of 6 months expenses in a reserve count. Now, with higher profits, you might consider investing in the growth of your business, which is the third option. This could involve maybe hiring more staff, expanding your physical premises, launching new products or services, or investing in marketing and advertising. Now, these investments could potentially lead to even higher revenue in the future. But please note that there will also be allowable deductions in the new tax year. And then our last recommendation is to set a time for your mid-year tax review now. Many business owners do what we call a tax check-in, usually between August and October. And despite the fact that this is actually late summer into early fall, you will often hear this referred to as a mid-year tax review. Now, this effort can be a very important one since it allows you to see where your tax liability is heading before the close of the year when many opportunities to affect your tax liability will end. Additionally, conducting a review can help you to understand your tax liability since you are required by law to pay at least 90% of your actual taxes for the current year or 100% of last year's taxes in order to avoid penalty. Now, a tax review before the end of the year can help you to plan how much more you're going to need to pay in estimated taxes to avoid paying even more in penalties. Now, the review involves checking your revenue, which is, of course, the money you took in so far, and expenses this year against last year, as well as the resulting profit, which is the revenue less your expenses. Now, you'll also want to check how much you have paid in taxes so far. So this process can be as in-depth as you choose, or you from just seeing if you are making more money to essentially preparing your own taxes.
Marlene, while you take a moment there, our friend at Homegrown just let me know that some of our providers might be signing off at 7 o'clock. Just so we can all be on the same page. We have enough content here to run us until 7:30. So if you all are able to stay on with us, Marlene will be ending our presentation closer to then. But Marlene, we had just a couple questions in the chat and a request if we could just address those before we finish our content and then come back to questions. Um, just in case providers do have to hop off at 7 o'clock. Is that okay with you, Marlene?
Sure.
So these were questions about time space calculation. I had some providers speak up about a question wondering if you can use time spent working at home in preparation for the business. So for example, this provider asked time spent on Zoom or doing bookkeeping or building a sandbox or materials for the business. Is that something that can be considered into your time space calculation?
So that goes back to when we talked about the time that you've spent before and after when the children are not present. That's exactly what we were referring to there. So yes, you can add that time up. In the example, we had the provider only spending an hour here and an hour there. But whatever your number is what you're going to add into that calculation.
And then I just have one other question. Oh, sorry, two other questions about additional spaces. So one is about an outdoor play area. if that can be included in your time space calculation. And then the other is about an exclusive use area that is, so there's a difference here. One is an outdoor play area and the other is an attached space, so a basement or a garage.
Yes, so I see the question, can the outdoor play area be used as time space? So the operative word for being able to count those in time space is to make sure that it is a physically attached property or a physically attached structure, if you will. So if it is not an enclosed playground attached to your home, then the answer would be no. But you can use like an enclosed porch or maybe even a deck that is attached to your property. And then, of course, let's see, the next one was that may we include finished basement space attached to the garage porch?
Yes, yes.
Okay, so may we include finished basement space and attached garage storage spaces. Okay, so if you're using it for storage, it's going to be, if it's your garage and you're using it for nothing other than the childcare, you can use it as exclusive. If it's not, then you're going to count it as regular. If you're storing items there, same thing for, let's see, storage space, total square footage of the home, yes. If you use exclusively for the childcare. So yes, the answer is yes, because your question was, if you're using that exclusively for the childcare, then you can count those. Were there any other questions that needed to be addressed
That's
before
all
we
I
move on?
that's all I have in the chat right now.
Sounds good.
Thanks, Marlene.
No problem. All right, moving on to our next section, which is how you can get your taxes prepared. And we're basically almost to the end anyway. So here is a brief pros and cons comparing paid tax preparers versus self-preparation to help you basically decide which method is going to work best for you and your business. Now, for paid preparers, when searching for tax preparation services or individuals, you want to look for someone who has been recommended by people in your network. Additionally, it is beneficial if they have child care specific expertise, particularly with businesses like yours. So if you are a home-based childcare provider, then you should be searching for someone who has specific expertise or experience working with home-based childcare providers. It's not going to be helpful if they just have experience working with centers or others. You can use those individuals, but the goal is to find someone who knows your industry. Now, the pros are that you're going to have a guide along the way, but the cons are going to be that this can be a more expensive method. Now, if you are going the self-preparation method, it's often more cost effective and efficient for most providers. Additionally, the IRS tends to audit online or computer generated tax returns less frequently, as they generally find these to be more accurate and beneficial for the taxpayer. Now, pros and cons are attached here. The pros are that the calculations can be more accurate and it can be less expensive. And the cons are that the guide would be an additional cost. Now, regardless if you decide to take everything to a professional tax preparer or to utilize additional resources and tools to complete your taxes on your own. You should implement systems now to track your income, your expenses, and deductions so that you can maximize your returns. Now, we do have some questions that when you're looking for a tax preparer for your business, you should ask some of these questions. The first is, are they qualified? Now, all tax preparers should have an IRS preparer tax identification number. In short, it's a PTIN. Now, paid tax preparers are required to register with the IRS. So be sure to ask for this in advance, as tax preparers are not allowed to do your returns without this number. And you can use the IRS directory to verify a PTIN credential. So just make sure that if you want to know if they have that, you can go to the directory provided by the IRS. The next question is, did they receive training? Ask if your tax preparer has any professional credentials. Enrolled agents who are licensed by the IRS, certified public accountants, or attorneys, they all work as tax preparers. Other qualified preparers may be participants in the annual filing season program, bookkeepers, or certified planners. You can search for qualified preparers in your area, or again on the IRS directory of federal tax return preparers. And thank you for dropping that link in the chat. The next question is, have they worked with with childcare businesses before, or do they understand your specific needs? Now, of course, experience is going to count when you're looking for those qualified tax preparers or those preparation services. In addition to checking for the length of previous experience, you want to make sure that your tax preparation service has knowledge that is relevant to, again, your specific circumstances. So ask if your tax preparer is part of any professional organizations, or if they take any continuing education courses, so that they stay up to date. Make sure that your tax preparer knows your state, local requirements in addition to the federal return requirements. You can also ask, are they going to be available after tax season if you happen to need advice or make changes? Sometimes there are those, what I call fly by night tax services, that are only here during tax season and then they disappear. And so if that's something that works for you, great. But you also want to make sure that if you utilize a service like this, uh, ask them if they're going to be available beyond tax season. Another question is, can you get a copy of your returns? You want to make sure that you have those hard copies of your filed tax returns and all the documents included in your filing. Now, aside from the fact that it's a good idea to have a copy for your records, a duplicate copy, you never know when you might need to get a copy quickly. So while, of course, like I said, those several of the online tax programs they will allow you to log in at any time and basically print or download a copy of your returns. Tax preparers may or may not be easy to reach outside of the tax season. So you are going to want to ask that question. Now, in addition to the hard copies of all the documents in your tax returns, we do recommend that you have electronic copies as well. Digital copies, again, could be made by scanning those hard copies and converting them to either PDFs, or simply taking a photo on your cell phone of those documents, and then saving them to a secure device. And then finally, you want to make sure that all the original documents submitted to your tax preparer are returned to you. You want to keep all of your receipts, all proofs of payments, your 1099s, and all other tax related documentation for at least 4 years. Now, if you want to complete your own taxes, there are online tax guides available for you to use as you do so. Now, these guides are designed specifically for childcare providers who want to use online tax software. We have guides available for TurboTax, H&R Block, and Tax Act, along with a buyer's guide to help you choose the software that best suits your needs. Now, in the chat, you will find a link to the TurboTax Self-Employed Online Tax Preparation Guide for childcare businesses. We also have included a link with all of the guides that will help you to understand stimulus funds or grants and taxes, um, managing business finances, and of course, business operations. Now, these tools are free, they're easy to use. They do include screenshots for better ease of use, and I highly recommend you going in and taking a look at those if self preparation is the option you choose. Oh, by the way, let me go back. We also have the QR codes that will take you there quickly if you opt to do the self preparation. Now, for self-assessment purposes, we do have the Confidence and Quality Tax Rubric app, which was developed based on actual family and center childcare providers' tax returns to help you basically with your tax preparers, to help you and the tax preparers to understand the specifics of the tax regulations for childcare. Now, the rubric is designed for sole proprietors and LLCs that are treated as single members or sole proprietors. Um, that is, they basically report their income and expenses on the Schedule C 1040. Now, providers with S corporations, C corporations, partnerships, LLCs who declare themselves as S corporations, you all can still benefit from using this app, but the expense lines will be different. Now, this app is free, it's easy to use, and we do encourage you to test it out for yourself and see how it works and how it can be a benefit to your business. We we have dropped a link for you in the chat. And again, the QR code is available on the screen, and these are available in both English and Spanish. Now, we also have a proactive tax planning tool that is particularly helpful in prior year's returns. That link has been dropped in the chat for you as well. And this is pretty much everything that we have for you today. So as we draw to a close, I want to just say that it's vital to reflect on the insight that's been acquired about accurately reporting your revenue and deductions for tax purposes. Now, the next critical step is for you to collect your financial data from the current year and facilitate a connection with the most suitable preparer, or if you're electing to do self-preparation, the most suitable software. Now, whether you decide to tackle your taxes solo or enlist the help of a qualified professional, very essential to take advantage of that confidence and quality tax prep rubric. This tool is very instrumental in maximizing your deductions and minimizing your risk. So we also strongly encourage you to utilize of course, the tax prep guides that were provided. And please note that the review of a tax situation using the information contained in this presentation is not suitable for carefully selecting a qualified tax preparer and should not be used in place of legal or accounting advice when needed. All right. Now we will open it up for questions once again.
Hi,
Hi,
my name is Marilyn Kirby. How are you?
I'm doing great, Marilyn. What's
Oh,
your question? How can I help you?
okay, I was asking. I thought when they give us the grant that we don't have to file that. I thought you don't have to file a grant.
That is considered income, and they will give you a 1099 for a grant. But when you spend the grant, you're going to turn around and write those expenses. So remember the example that we talked about where you received $10,000 and then you spent $10,000. And so your tax liability will then be zero on that grant if you spend it in the same year. Does that make sense, Ms. Marilyn?
Yeah, because I was talking to the attorney and he said that you grants are given to us. We don't have to claim that.
Okay, well,
And so that's, and I noticed on some of the grants, you get a 1099 and some of them you don't. And he said you're not supposed to.
that's interesting.
Mhm.
The information that we have is that all grants are considered as income, and if you get a 1099 for it or not, you do need to put it on the income section, but you just write it off. So it basically is a wash. It turns out to be zero in the long run, so it's not really impacting you unless you spend the funds in a different year or don't spend all the funds.
Okay.
There's a case in mine, like I got the facility grant and I remodeled the kitchen. Now we use the kitchen for my home use and childcare. So we have to do that as a shared expense, so that can't be a washout.
Okay. Yeah, there can be some nuances to uh all of it, but as far as I can certainly uh check with our expert tax an individual on our team to make sure that these are um because I can't specifically talk to your, exact situation unless we have more details, Miss Debbie, but we can certainly clarify the information and make sure that what you have is accurate. But to my knowledge, this is how the income should be reported on. If you receive a 1099, you're basically going to report it as income and then turn around and write it off in an expense.
But I was just thinking if it went to time space, if the space you're remodeling, like say with that facility grant, the kitchen is not used 100% for childcare. So that's why I
Right.
was thinking it probably can't, but if my kitchen was used 100% for my childcare, see, that's where um I was kind of questioning that.
Yeah. Um, so in time space, we're talking about the time and the space. If you are buying, like say for instance, you bought some equipment that was for the remodel, that equipment should be written off. But again, like I say, I will make sure that we get you guys some confirmed information on that, just so that we can be 100% on the same page.
Yeah, because I want to just be sure people, do it right. You hate to get audited because like I spent
Absolutely.
36,000 on that
Mhm,
kitchen. And I
mhm.
know that if they came here, they're going to see that, wait a minute, your kitchen is upstairs, your childcare is 100% downstairs. And yes, you do prepare food, so it is shared. So
See,
and
Debbie,
that
that's what I was
I
talking.
just wanted, I'm sitting there going, oh, I don't think I could claim that 36,000 off. I mean, I can do it as shared as an expense, and there's a formula for that.
Yes, and basically what you just gave some more specifics, and you see why we can't necessarily just say one or the other. It's like the information you said upstairs and downstairs, that was an additional piece of information that your tax advisor would need to know and would know in order to, get you in the right place for claiming that or not. But like I said, as far as we know, the income that you receive for a grant is income and needs to be claimed as income. And you should receive a 1099 for that. You put in the income section, and then any expenditures would be written off in the expense section. But thank you, Marilyn and Debbie, for chiming in about that. And like I said, we will make sure to get you some additional information in terms of clarity.
Thank you. Debbie, could you put in the chat about the grant for helping you with the kitchen?
Yeah, thank you, Marilyn, for saying that. Yeah, Debbie, go ahead and jot your question down in the chat so that we have reference of that and we go back and get that information if you don't mind. All right, thank you, Debbie and Marilyn. Any other questions?
I have another question in the chat, Marlene. And we might need, if Jennifer is still here on the call with us, we might need her to help clarify this. This question came from Jennifer Smith. Oh, I see you came off mute. Do you want to speak your question?
Yes, I just got my license in February of 24. Before getting my license, of course, there was work that I had to do in the basement. That was done, of course, in 2023. So am I able to use any of those receipts since it was for that for the 2024?
So what you spent in 2023, you're asking if you can expense it in 2024?
It was in order to get licensed. The money that I had to put out at the end of 2023, it was so I could open my business in 2024.
So yeah, sometimes when you have expenses in the previous year, those are operational expenses that you have that you will incur to start your business. We usually tell people that those write-offs should happen in the year that they occurred. Um, so I would say that this would be a speak to your tax professional and make sure that if you're trying to write off those expenses in 2024, that that will be allowable. Um, because you do have startup expenses, even though you didn't have the business, but you needed to do these things, you needed license, you needed all those things, right? But
Right.
in 2024, you incurred business expenses because you were then open. You might have had some, depending on when you started your business, you may have had some more additional initial startup expenses, but the bottom line is your business was up and running in 2024, and you need to make sure that you claim all of those expenses. So I will reiterate, make sure that you have this conversation with a tax professional to if you're trying to claim those expenses in the previous year, that
Yeah, because
that is something.
in order for me to get my license, like we had
Mhm.
to redo the bathroom. It had to be a larger space for wheelchair purposes for handicap. And that was
Absolutely.
all done, of course, at the end of 2023, but I was not able to open for business until February of 2024.
So Jennifer, what I could tell you though is if it's not allowed to claim those expenses in 2024, you do have the option to amend your taxes. You can go back and amend your taxes up to 3 years. So
Oh,
that
okay.
is, it's not a loss one way or the other. You just need to make sure that you're doing it the right way. So again, have that conversation with your tax professional, explain the situation and ask, is this something that I can claim in the current year? Or can I amend my previous year's taxes to account for those expenses?
I want to piggyback on that. I think that she's gonna have to. That's for 2024 because she didn't open her business in 2024, so that would be part of her startup course.
That's correct.
Hmm. She could claim it. You could claim it, Jennifer. It'd be a startup course.
All right. Thank you for your question, Jennifer. And thanks for chiming in, Marilyn. But again, like I said, confirm everything with your tax professional. Okay, perfect. All right, any other questions? I don't see anything in the chat. You are welcome. And all right, so in case you weren't able to get your questions answered during tonight's webinar, know that the Tom Copeland blog is full of information that most likely will have an answer to the questions that you have. And don't forget to subscribe to our monthly newsletter, stay in the know. And if you can't find the answers that you're looking for in the Tom Copeland blog, we do have an Ask the Experts portal section of that blog. So you can use that to gain access to multiple resources. The QR code is available. You're welcome, everyone in the chat. And again, Margaret has dropped that in the chat for you. And we do thank you for attending tonight's presentation. You can stay in touch with us by visiting us on the information that you see on the screen at www.civitas or civstrat.com. Or you can email us at info@civstrat.com. And don't forget to stay in the know by signing up for our mailing list. Take care, everybody. Have a wonderful night. And we will make sure to get you the information that we promised that we're going to confirm. All right. Take care.
Thank
You're
you.
welcome. Take care.
Thank you.